So today I want to talk about what may turn out to be one of the most consequential strategic miscalculations in the history of modern finance: the decision to freeze Russia's foreign exchange reserves in February 2022. And I want to explain not just what happened on that day, but what the economic and financial data shows has been happening in response to that decision in every major central bank and sovereign wealth fund on earth in the months and years since that pivotal moment. Because the story of what has actually happened to the dollar's position in the global financial system since February 2022 is not the story that most mainstream financial coverage is telling you. And the implications of what the data actually shows will affect the value of your savings, your pension, your mortgage rate, and every financial instrument denominated in US dollars for decades to come. Let me start with what the decision was and why it was unprecedented. When Russia invaded Ukraine in February 2022, the United States, the European Union, and their allies responded with a range of financial sanctions. One of those sanctions was the freezing of approximately $300 billion in Russian sovereign foreign exchange reserves held in Western financial institutions and clearing systems. Russia had accumulated these reserves over years, precisely as a buffer against economic shocks, as a store of national wealth, and as a mechanism for managing its currency. They were held in dollars, euros, and other Western currencies because the global financial system runs on those currencies. And with a single coordinated decision, approximately $300 billion of sovereign assets belonging to a major nation were rendered inaccessible to their owner, not seized permanently at that point, frozen, but frozen in a way that made their ultimate fate uncertain. Now, here is the question that every finance minister, every central bank governor, and every sovereign wealth fund manager immediately began asking: if it can happen to Russia, can it happen to us? And the answer, the data shows they arrived at, not through statements, but through their actual reserve management behavior over the months and years that followed, is a clear yes, it can happen to us. And we need to reduce our exposure. And if you are finding this analysis useful, please subscribe. I cover these structural shifts in the global financial system every week because the dollar's position as the world's primary reserve currency is the foundation on which American living standards and the long-term sustainability of American debt both depend. And that foundation is visibly shifting right now. Let me walk you through what the data shows has been happening since February 2022. The first and most dramatic signal is gold purchases by central banks. Central banks globally bought more gold in 2022 than in any year since 1967. They bought more gold in 2023 than in any previous year on record. The nations leading this gold accumulation are not small or marginal economies. China, India, Turkey, Poland, Singapore, and numerous other nations have been consistently adding to their gold reserves at rates not seen since the Bretton Woods era. Gold does not earn interest. It does not provide the liquidity that dollar reserves provide. Central banks do not accumulate gold for financial return. They accumulate gold because gold cannot be frozen, cannot be sanctioned, cannot be rendered inaccessible by a political decision in Washington or Brussels. It cannot be excluded from a payment system. It cannot be made subject to a foreign government's jurisdiction. It sits in a vault, and whoever owns the vault owns the gold, regardless of what any foreign government decides. When central banks are willing to trade the yield and liquidity advantages of dollar reserves for the one property that gold uniquely provides, the property of being beyond the reach of any foreign government's sanctions authority, that is not a routine portfolio management decision. It is a fundamental reassessment of the risk landscape of global reserve management. And the People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey, the National Bank of Poland, the Monetary Authority of Singapore, and dozens of other central banks have all been making that reassessment simultaneously and arriving at the same conclusion. The scale and geographic breadth of the gold accumulation since February 2022 is the clearest possible market signal that the freeze of Russian reserves permanently changed the risk calculation of sovereign reserve managers around the world. They are not saying it in press releases. They are saying it in their balance sheets. And balance sheets do not lie. The second signal is the gradual but measurable decline in the dollar's share of global foreign exchange reserves. The dollar's share of global reserves peaked at approximately 72% in 2001 and has been declining since. By 2023, it had fallen to approximately 58%, the lowest level in decades. The pace of this decline has notably accelerated since 2022. This is not coincidental timing. The currencies gaining share are not primarily the euro or the yen or other traditional reserve currencies that would represent a simple rotation within the Western financial system. They are a diversified basket of smaller currencies, including the Chinese renminbi, the Australian dollar, the Canadian dollar, the South Korean won, and others that represent a genuine fragmentation of the reserve allocation across more counterparties and currency jurisdictions. This fragmentation strategy is the logical response to demonstrated concentration risk. If holding 70% of reserves in one currency exposes a nation to the risk of having all of that 70% frozen in a geopolitical dispute, spreading reserves across 15 currencies limits the maximum exposure to any single freezing action. This diversification is not happening because these alternative currencies have become more attractive in absolute terms. It is happening because the concentration risk of holding reserves primarily in a currency that has demonstrated it can be weaponized has become unacceptable to a growing number of reserve managers. The third signal is the acceleration of alternative payment infrastructure. The SWIFT messaging system, through which the vast majority of international financial transactions are coordinated, is effectively controlled by Western institutions and subject to Western government pressure. The exclusion of Russian banks from SWIFT in 2022 demonstrated what many had theorized but never seen in practice at this scale. That access to the global payment system is not a neutral technical infrastructure available to all participants on equal terms. It is a geopolitical tool that can be selectively withdrawn. And once that demonstration was made in practice rather than in theory, the rational response of every nation that might conceivably find itself in geopolitical conflict with the West was to begin developing alternatives. In response, multiple nations have accelerated the development of alternative payment systems that route transactions outside the SWIFT architecture. China's cross-border interbank payment system has expanded significantly in both membership and transaction volume since 2022. Russia and China have substantially increased the share of their bilateral trade settled in renminbi and rubles rather than dollars. India and Russia have conducted significant volumes of trade settled in rupees. The BRICS grouping has been explicitly and publicly discussing the creation of a common payment infrastructure and potentially a common reserve currency that would reduce dependence on dollar-denominated settlement systems. None of these alternatives is yet capable of replacing the dollar and SWIFT at global scale. But the direction of travel is unambiguous. And the direction of travel is away from dollar dependence. If you have not subscribed yet, please do that now. The payment infrastructure shift I am describing is one of the slowest moving but most consequential structural changes in the global financial system, and it directly affects the long-term value of dollar-denominated assets. Now let me explain the economic mechanism by which all of this connects to your financial life. The dollar's reserve currency status is not just a matter of geopolitical prestige. It has concrete economic consequences for ordinary Americans and for anyone holding dollar-denominated assets. When every nation needs dollars to conduct international trade and to hold as reserves, they must earn those dollars or borrow them. This creates a permanent global demand for dollars that supports the dollar's value and, critically, creates a permanent global demand for U.S. Treasury bonds, the instrument through which nations invest their dollar reserves. This permanent demand for Treasury bonds is a large part of what allows the United States to borrow at the scale it does, with a national debt now exceeding $36 trillion without facing the kind of bond market crisis that would afflict any other nation attempting to borrow at similar scale relative to its economy. It is sometimes called the exorbitant privilege, a phrase coined by French Finance Minister Valéry Giscard d'Estaing in the 1960s to describe the unique advantage that reserve currency status confers on the issuing nation. That privilege has allowed America to run persistent trade deficits and fiscal deficits for decades without the currency devaluation and rising interest rates that would normally follow. If the global demand for dollar reserves declines meaningfully, the demand for treasury bonds declines. If the demand for treasury bonds declines, the interest rate the U.S. government must pay to attract buyers rises. If American borrowing costs rise, every interest rate in the American economy that is benchmarked to treasury rates rises with it. Mortgage rates rise, corporate borrowing costs rise, consumer credit becomes more expensive. The fiscal cost of servicing the national debt, already over $1 trillion per year, rises further. All of this makes the American economy structurally more expensive to operate and gradually erodes the standard of living advantage that the exorbitant privilege of reserve currency status has provided to American households for 3/4 of a century. The strategic calculation that led to the freezing of Russian reserves was almost certainly made without adequate weight being given to this second-order effect. The immediate tactical objective, applying maximum financial pressure on Russia, was achieved. Russia's economy was disrupted. Its access to Western financial markets was severely curtailed. The ruble fell, inflation rose, Russian consumers and businesses faced severe hardship in the months following the freeze. Measured against those immediate tactical outcomes, the decision looks effective. But the signal that the decision simultaneously sent to every other nation holding dollar reserves, the signal that said your reserves can be frozen if you make decisions that Washington disapproves of, may, in the long run, cost far more than the tactical benefit achieved. Because the nations that drew that conclusion are not small or isolated economies. China holds approximately $3 trillion in foreign exchange reserves. Saudi Arabia holds hundreds of billions. The Gulf Cooperation Council collectively holds trillions. India holds hundreds of billions. Every one of these nations is now holding dollar reserves that they know, from the Russian precedent, can be frozen under sufficiently adverse geopolitical circumstances. And every one of them is rationally asking how much of that risk they want to carry. The answer they are giving, again, measured not in statements, but in actual reserve management behavior, is less than before. The dollar's reserve status has been the single most powerful structural advantage in the American economic system for 75 years. It has allowed America to borrow cheaply, to run persistent deficits, and to maintain living standards that its underlying productivity growth alone would not support. Every percentage point of global reserve share that the dollar loses translates into higher American borrowing costs, reduced fiscal flexibility, and a gradual erosion of the economic advantages that reserve status has provided to ordinary American households. The weaponization of the dollar may have won a battle in Ukraine while beginning to lose the longer war for dollar hegemony. Subscribe for more analysis of these structural shifts in the global financial system explained clearly and plainly. And tell me in the comments, do you think the freezing of Russian reserves was a strategic mistake in the long run, or was the principle worth the cost to dollar hegemony? See you next time.